The US dollar is often said to be the anchor of the global financial order, the ultimate safe haven whenever the world is in turmoil. But if that remains true, why, during the same period, is the US issuing debt at a record pace, interest rates remaining persistently high, while people's purchasing power dwindles month after month? This issue isn't reflected in the exchange rate board. It's in household bills, mortgage costs, credit card interest rates, and the widespread unease despite headlines claiming the economy is resilient. In this video, we'll trace the rarely seen interconnected links, the role of the Federal Reserve in a persistently inflationary environment, the burden of public debt forcing monetary policy compromise, and what happens when confidence in the global reserve currency begins to show small but persistent cracks. A few initial signs are enough to raise questions. The US dollar hasn't collapsed, but it's more volatile than the previous cycle and has lost some of its appeal compared to an alternative asset basket. High interest rates help curb inflation, but at the same time inflate the cost of debt repayment for governments and households. Globally, central banks are talking more about diversifying reserves, while gold is being bought net on a scale not seen in years. These figures, taken individually, could be explained as cyclical adjustments. Taken together, they tell a different story, a system operating in a fragile equilibrium, where every central bank decision has a cost on the other side of the economy. At the policy level, the story on the surface sounds plausible. The Fed must keep interest rates high enough to prevent inflation from returning. The labor market is still creating jobs. Growth hasn't broken. But beneath that surface, the allocation pressures are shifting. Higher capital costs aren't evenly distributed. It places the burden on borrowers, small businesses, and the public budget, while the benefits of price stability arrive more slowly in daily life. Will the USD lose its crown overnight? More importantly, if monetary confidence is no longer absolute, if the Fed is caught between inflation, fiscal stability, and public debt, where will that pressure spread first, the market, the budget, or the consumer behavior of millions of households? On the surface, the story of the USD and US monetary policy is still told in a familiar pattern. Inflation has cooled from its peak. The labor market is still creating jobs. Growth has not broken. In that picture, the USD is seen as a pillar of stability, no longer too strong to stifle exports, nor too weak to threaten its role as the global currency. Overall inflation has fallen from its peak, partly reflecting the impact of the previous series of aggressive interest rate hikes. The labor market continues to show considerable resilience, with unemployment remaining relatively low by historical standards. Nominal consumption has not collapsed, and GDP continues to grow, albeit at an uneven pace across quarters. The role of the Federal Reserve is described as a difficult but manageable balancing act. High interest rates are seen as a necessary measure to protect the purchasing power of the currency. The policy of keeping interest rates high enough for a long enough time is framed as a disciplinary measure to bolster monetary credibility after the inflation shock. The US dollar, therefore, remains perceived as a relatively safe haven in a world of uncertainty. On a global level, the surface picture is further reinforced by comparisons. Europe grapples with low growth and energy risks. Several emerging economies are under pressure from exchange rates and capital flows. In this context, The U.S. stands out due to its size, the depth of its financial markets, and its ability to absorb shocks. The U.S. dollar doesn't need to be excessively strong to maintain its position, it just needs to be more stable than the rest. This narrative sounds plausible because it aligns with traditional economic models. Falling inflation signals that policy is working. High interest rates reflect a serious commitment to protecting price stability. The dollar fluctuating within an acceptable range is seen as a cyclical adjustment, not a structural crisis. In that logic, confidence is placed in the central bank's ability to navigate and the resilience of the U.S. economy. But this very framing creates blind spots. Key macroeconomic indicators measure activity, not directly allocation pressures. They show the economy is functioning, but don't indicate where the costs are concentrated. When the narrative is primarily told through GDP, average inflation, and unemployment, everyday stresses are easily pushed out of the picture. Here, the USD appears as a technical variable, strong or weak against a basket of other currencies, how it reacts to interest rates and capital flows. It's rarely placed within the context of real-life experiences, real purchasing power, borrowing costs, or household financial security. And when the Fed is viewed primarily through its inflation target, the side effects of prolonged monetary policy are often seen as acceptable lags. The surface picture is therefore just reassuring enough. It doesn't deny risk, but it also doesn't view current tensions as signs of a deeper problem. The dollar hasn't collapsed. The system is still functioning. And in the mainstream narrative, that's seen as proof of policy correctness. However, as the good enough numbers persist, another question emerges. If the economy is truly as stable as it appears on the surface, why is financial anxiety so widespread? And if the dollar remains central, why is pressure on budgets, households, and confidence increasing simultaneously? When the data is presented in a way that seems reasonable enough to reassure the public, but anxiety persists throughout society, the gap between the data and the lived experience begins to surface. And that gap is where closer scrutiny is needed. At the household level, the story of the dollar and monetary policy takes on a very different nuance. Inflation may have fallen on the charts, but the cost of living hasn't returned to its previous levels. Housing, insurance, healthcare, education, and loan interest continue to erode real income. For many families, the feeling of weakening money doesn't come from exchange rates, but from the widening gap between wages and expenses. High interest rates, the primary tool for protecting the value of money, are a direct source of pressure on living standards. Home loans are becoming more expensive, refinancing is more difficult, and short-term debt like credit cards carries interest rates not seen in years. As the Fed maintains its tightening stance for an extended period, the cost of capital is not evenly distributed. Those with assets benefit from higher yields, while borrowers bear the pressure on their cash flow. This imbalance is evident in widespread behavior. Households are delaying major decisions: buying a house, upgrading a car, investing in education, not because of a lack of jobs, but because of a lack of safety margin. Consumption is shifting to defensive, prioritizing necessities, cutting discretionary spending, and extending the life cycle of assets. Small adjustments, when occurring simultaneously on a scale of millions, create an invisible drag on the real economy. For the middle class, the paradox becomes clear. Nominal income may rise, but real income is eroded by escalating fixed costs. Renters face persistently high rents. Homeowners are burdened by interest rates and taxes. Young people enter the labor market with significantly higher starting costs than previous generations, while initial savings are thinner. The feeling of a weak dollar here is the inability to translate income into long-term security. On the small business side, high interest rates expose a different reality. Working capital is more expensive, expansion is constrained, and profit margins are under double pressure from input costs and consumer defensive demand. These businesses don't stand out in market indices, but they are the direct absorbers of the prolonged impact of monetary policy. A key point is the delay in statistical reflection. GDP and employment measure activity, not stress levels. They indicate that the economy is still running, but not how much wear and tear the system is experiencing. When stress is dispersed into small adjustments in daily life, it's less likely to create an immediate shock, but it accumulates risk over time. Here, the role of the US dollar becomes paradoxical. On the one hand, tightening policies aim to strengthen purchasing power and monetary credibility. On the other hand, the cost of that strengthening is passed on to present-day living, undermining the sense of financial security. The currency may stabilize in international markets, but intrinsic confidence, the belief that today's income is sufficient for tomorrow, is eroded. The discrepancy between data and reality is therefore not a random phenomenon. It is the result of an allocative mechanism. Policies are designed to stabilize the macroeconomic system, but their impact is uneven across different groups in the economy. When these pressures persist, the question is no longer how individuals have spent, but how the system is forcing them to adjust. This discrepancy is not the result of isolated individual choices. It is formed from the mechanisms operating behind policy, where pressures are distributed subtly but simultaneously. To understand why the gap between data and reality is widening, we need to move beyond superficial phenomena and look at the system's underlying structure. At the heart of that structure is the Federal Reserve, with a familiar set of tools but a completely different environment than in previous cycles. The issue isn't whether the Fed is right or wrong, but rather that the space for choice is shrinking simultaneously from multiple sides. The first link is inflation, which is more persistent than expected. After the initial shock, inflation didn't disappear as quickly as models had predicted. Part of the pressure comes from services, housing, and labor costs components that react slowly to interest rates. This forces the Fed to maintain its tightening stance longer, not only to bring inflation down, but to protect monetary credibility, the message that the purchasing power of the USD will not be sacrificed for short-term growth. But that policy immediately clashes with the second link, public debt. For years, the US has been accustomed to a low-interest rate environment, where government borrowing costs were comfortably compressed. When interest rates remain high, the debt structure becomes more sensitive. Each reissue of bonds carries higher interest rates, inflating the budget's interest payment obligations. This pressure doesn't need to create an immediate crisis to be dangerous. It acts as a drag, narrowing fiscal space and indirectly burdening monetary policy. Here, the Fed faces a paradox. Keeping interest rates high strengthens the dollar and curbs inflation, but simultaneously increases the cost of financing for the government and the entire system. Lowering interest rates could reduce debt pressure in the short term, but risks inflation expectations and monetary credibility. This stuck isn't a misguided choice, but rather the result of a structure where policy objectives begin to conflict. The third link is financial stability. After years of financialization, the system relies heavily on low capital costs. As interest rates rise rapidly and remain high, underlying weaknesses emerge, asset valuations come under pressure, leveraged business models are challenged, and interest rate-sensitive areas from commercial real estate to consumer credit begin to signal strain. The Fed, in its role as stabilizer, cannot ignore these risks. It is at the intersection of three links: inflation, public debt, and financial stability that the role of the USD becomes complicated. A nominally strong currency can attract capital and maintain its global position, but that strength comes with an intrinsic cost. It tightens financial conditions, increases the debt burden, and amplifies allocation imbalances. The USD is not weak in the sense of collapse, but it is drawn into a more strained role, both a stabilizing tool and a source of pressure. Another often overlooked factor is the lag. The impact of monetary policy is not immediate. Today's high interest rates may only show their full consequences after several quarters, or even years. During that time, the system continues to operate, but with increasing wear and tear. By the time indicators begin to clearly reflect the strain, the room for adjustment is usually much narrower than when the policy was established. Finally, we need to look at the global context. The position of the US dollar allows the US to prolong this fragile equilibrium longer than other economies. But that very privilege also makes the risks harder to identify. When pressure is dispersed through international capital flows and global financial markets, it doesn't disappear, it just shifts location and accumulates in a less conspicuous way. When these links are under pressure for an extended period, the pressure no longer remains at the center of policy. It begins to spread outward, into daily economic life, and leaves behind more subtle risks. When monetary policy remains under prolonged stress, the impact doesn't stop at inflation or exchange rates. Pressure begins to spread through less noticeable channels, from households to small businesses, from local budgets to the credit system, and back to the financial center in the form of confidence risk. At the community level, high capital costs and defensive consumption create a negative feedback loop. Small businesses, the backbone of many regions, face weaker demand while financing costs rise. Jobs aren't collapsing en masse, but hiring is slowing, hours are being cut, and expansion investment is being delayed. These adjustments are unlikely to make headlines, but they are eroding the local economic foundation in a persistent way. Further pressure is emerging within the credit system. As households rely more heavily on short-term debt to cover living expenses, credit quality is deteriorating. Delay rates are rising first in less noticed segments: credit cards, consumer loans, small loans, before spreading to larger areas. This isn't a 2008-style shock, but rather a fragmented accumulation of risk, difficult to identify simply by looking at aggregate indicators. In this context, the global role of the USD creates another paradox. International capital flows into the USD and US assets help maintain liquidity and mitigate short-term stress. However, at the same time, they push asset prices higher relative to real income, widening the gap between markets and living standards. The benefits of a global currency position are concentrated in financial centers, while the costs spread throughout society. An often downplayed risk is the shift in long-term behavior. As financial insecurity persists, people adjust their expectations. Defensive saving becomes the norm, not a temporary option. Long-term decisions starting a family, buying a home, investing in education are delayed or scaled back. These behaviors don't immediately reflect in GDP, but they shape growth trajectories for years to come. It's also important to consider the invisible groups in statistics. Long-term renters face pressure from high rents without assets to protect themselves. Self-employed workers and the gig economy lack safety nets as the cost of capital rises. Older adults relying on fixed incomes face escalating living costs that are outpacing their ability to adjust. These groups rarely feature prominently in narratives about the dollar or monetary policy, yet they are the ones most acutely affected by the erosion of economic confidence. At a systemic level, the risk isn't a single breaking point, but a confluence. When multiple sectors are under just enough pressure to avoid collapse, but enough to limit response, the system enters a vulnerable state. Each small shock, financial volatility, geopolitical tension, or policy misstep can amplify faster than expected because the foundations have already been eroded. What the media often overlooks is the link between these pressures and confidence. The dollar may be central on paper, but economic confidence isn't measured solely by foreign exchange reserves or capital flows. It is measured by life expectancy, whether income keeps pace with costs, and whether the system continues to provide long-term security for the majority. When those pressures accumulate without creating an immediate shock, the first thing to change isn't the market, but expectations. And from expectations, economic confidence begins to shift towards a defensive direction. Economic confidence doesn't appear on the balance sheet, but it's the most powerful variable influencing behavior. When confidence weakens, individual decisions, consumption, investment, saving all shift to a defensive state. And that very defensiveness, when widespread, can create a stronger drag on growth than any external shock. In the current context, the role of the USD and Federal Reserve policy is viewed through a different lens than in previous cycles. The currency may not lose its global standing, but the sense of security associated with it has changed. People aren't questioning the exchange rate, but rather purchasing power, the ability to accumulate wealth, and whether today's income will still guarantee a secure future. This shift reflects a deeper paradox. The tools designed to stabilize the macro system are creating micro-level psychological pressure. High interest rates bolster monetary credibility, but at the same time prolong uncertainty for households and small businesses. Each tightening decision is justified by necessary logic, but when prolonged, it gradually transforms into a feeling that the system no longer prioritizes the living experience of the majority. The crisis of confidence doesn't erupt like a classic financial crisis. It spreads slowly, silently, and is difficult to measure. People aren't withdrawing money en masse, but they are withdrawing expectations. They aren't completely stopping spending, but they are avoiding risk. These behaviors, when accumulated, alter the structure of demand, slow the impetus for innovation, and prolong a state of growth below potential. At the policy level, there is no simple way out. Lowering interest rates too early could damage monetary credibility. Maintaining tightening for too long could deepen social disparities and defensive sentiment. The Fed faces not only a technical dilemma, but also a confidence dilemma: how to conduct policy while acknowledging the social cost of prolonged stability. This also raises a broader question about the dollar's position in the global order. A reserve currency needs to be held not only because of a lack of alternatives, but because of confidence in the economy behind it. When internal confidence weakens, its global role may still exist, but with increasing strain demanding that policy pay a higher price to maintain it. There are no predictions of a collapse date, nor are there absolute conclusions. What is happening resembles a transitional phase, where the system remains stable, but social and psychological foundations are under pressure. The dollar may continue to play a central role, but the more important question is, how and for how long are the social costs of maintaining that role being distributed? The ultimate issue is not whether the currency is strong or weak on the exchange rate board, but how long this system can maintain social trust. When trust becomes the most fragile variable, any superficial stability comes with a silent price.